FTSE Russell is an index provider and research house under the LSEG umbrella. They specialize in convening the best ideas on evolving market trends and helping to develop strategies for global investors. In this series, we look at the evolution of the biggest of today's trends. No one needs reminding of the effect global warming is having on the planet, but is enough being done to predict what it will do to our financial system? Prior to being founding partner at Kepos Capital, Bob Litterman led a US subcommittee that was commissioned to investigate this impact, and I talked to him about the repercussions of his findings. Bob, thank you so much for taking the time to chat with us. And we want to talk specifically about the world of sustainable investing. But just before we do that, let's talk a little bit more about the subcommittee. We were just talking about it earlier. Yeah. It sounds like it was the first of its kind to be formed. And what specifically was the role?
Yeah, it was kind of unusual because it was under the previous administration. Okay. And one of the commissioners of the Commodity Futures Trading Commission, Russ Benham is his name, is a sponsor of a committee called the Market Risk Advisory Committee. They had some hearings on climate-related risk and decided to create a subcommittee. Chairman Benham asked me to chair that committee. I was very honored to do so. There were 35 members of the committee representing a vast diversity of participants in the financial system, including banks, insurance companies, investors, asset owners, corporates, including oil companies, ag companies, data companies, and exchange. Also a number of academics, a number of environmental NGOs. So we really had a diverse group, and the commissioner said, we'd like you to write a high-level report. He hoped it would be 50 pages, come up with a number of specific recommendations and justifications for those. And he raised kind of a high bar. He said, I'd like it to be unanimous. And I thought, okay, didn't realize how high a bar that is. You realize you have 35 people and any one of them can say no.
Okay.
And in fact, it was even worse than that because he said, we want not just the individuals represented here, but their organizations. So our draft report went to all the general counsels and they had to sign off on it.
So this is very much a cross-industry type of report.
Yes.
So what I'm interested in is, at that time, take the financial world, for example, banks and insurance companies, was an aim of the report to try and highlight the fact that they were not appreciating what kind of risk the climate change was going to happen to their industry. It was more about, pricing into their products that they were selling to clients, or what was the approach of it?
No, I don't think it was either of those. I think it was designed to say, what do we have to do to protect the financial system? That's what the financial regulators are supposed to do. Mm. And the commissioner felt, and the commission itself felt, that the other financial regulatory groups, the Financial Stability Oversight Council, the Fed, the SEC, had not addressed climate-related risk for reasons that are understandable under the previous administration. But it seemed to the to the Commodity Futures Trading Commission that someone ought to do this. It's interesting, the CFTC is responsible for regulating derivatives markets in the US, and so it has a very strong focus on risk management.
Right.
And
I mean, that's, I guess one of the main primary uses of derivatives is to manage your own risk.
Exactly. So they have a market risk advisory committee, and since no one else was focusing on climate-related risk, they decided to go ahead and do that. And we were very pleased in the end that we were able to write. Actually, we accomplished everything the commissioner asked for, except we couldn't keep it to 50 pages. It was like 170 pages.
But you got all 35 unanimous votes.
We did, and we got 53 specific recommendations, including, I was very pleased, the first recommendation, and the most important and urgent, is that we have to put a price on climate risk, on carbon emissions. Yeah. And everyone agreed with that. Actually, that one wasn't hard to get through. The other thing that we got through that I was very pleased with is that climate-related risk, it needs to be disclosed. And, at the time we wrote this report, there was not adequate disclosure. Now, we're moving in that direction. There's a lot of work to do, but under the current Financial Stability Oversight Council, which is chaired by Treasury Secretary Yellen, the Fed, the SEC, the CFTC, and all the other financial regulators are now really moving forward with the agenda that we put into this report.
And can you talk a little bit about other geographies? Has this become a more coordinated event, or is this still something that is more specific?
Yeah, something that I think most people don't realize is how far ahead of the U.S. Europe is. Europe has strong incentives to reduce emissions. They have strong disclosure requirements.
There's also markets for carbon trading, is that right?
Markets for carbon trading that have a very significant price. The diversity of incentives to reduce emissions across the globe is not appreciated. In Europe, there are incentives over $100 a ton.
And so how far do you feel how do you think America is doing now, if you were to give it a grade?
It's doing terribly right now. We don't have a price on carbon. We're not moving in the right direction. We're on the wrong path. I think the good news is the corporate community understands that. You know, everyone supports a price on carbon now in the business community, in the finance community. That was unanimous recommendation of ours. There was no pushback. At the first meeting of the subcommittee, I said, you know, I think we need to put a price on carbon. Does anyone disagree? No one said no. Even the oil companies, so we get it.
Yeah.
You know, the American Petroleum Institute supports putting a price on carbon. The Chamber of Commerce, the Business Roundtable. Our report was written primarily for the financial regulators, but they can't put a price on carbon. The financial community can't put a price on carbon. It's got to be governments. And it's not the White House, it's Congress.
So am I thinking about this right, in that, you know, let's hope we do get a price set for carbon, and then that increases the cost base for those companies, and then investors start directing their money away from those companies, and then there's the financial incentives to stop investing in these companies. Does that sound about right?
It is about right. I mean, incentives are so important. That's fundamental. People respond to incentives. You want to change behavior, you change incentives. And in a modern capitalist economy, that's wages and prices. Right now, we have no price on carbon. There's no incentive to reduce emissions. And so, you know, if pollution is free, people are going to pollute. You know, it's the same in the financial community. If risks aren't priced correctly, then, you know, capital flows in the wrong direction. And this is absolutely the case. The only caveat I would say, and it's an important caveat, is that investors are forward-looking. And so if I'm sitting here today thinking about a capital investment over the next 20 years, it's not just the price of carbon today, it's my expectations of the incentives to reduce emissions over the lifetime of the investment that's going to drive the capital. And what you are seeing these days is a rapid change in expectations of those incentives. And so capital is starting to flow in the right direction, especially long-term capital. But, you know, it's not fast enough, and we have to move. And if they're disappointed because we don't get those incentives, well, then it's a step in the wrong direction. And we don't have any time to waste.
Right.
We should have done this 20 years ago. We wouldn't have a problem. Instead, we have an existential threat to the well-being of future generations. And that risk is growing, growing faster now than it was 20 years ago. 20 years ago, we had time.
Yeah.
Today, we have no time. In fact, it's too late. We are seeing catastrophic impacts of climate change already. We can't turn back the clock. The best we can do is preserve the well-being of future generations. And every day that we delay is a step in the wrong direction.
So speaking of future generations, are you somewhat hopeful, given, and I hate to generalize and call millennials, but let's say people under the age of 35 are just so much more environmentally aware than the older generation. Does that give you a glimmer of hope that this can change faster, or is it still too late by the time they're making decisions?
Well, it gives me a lot of hope, and I think we're on the cusp of, you know, globally harmonized pricing, at which point the whole capital markets will move in the right direction, technology will be developed, people will have the right incentives, and I think we'll make a lot faster progress than people expect. So that gives me hope, but every day that goes by that we haven't done it is a problem.
I was watching an interview recently with a man called Robert Friedland. I don't know if you know who he is, from Ivanhoe. And he was really saying that we are just going to have to transform the world, you know, away from hydrocarbons into electric. But we just don't have the electric grid infrastructure right now. And actually his point was that China was slightly ahead of the US. A lot of the US electrical grids are still quite dated. And so we need this big infrastructure spend to go into, you know, the sort of, to having the capability to have enough electricity, because we all take for granted that, you know, when we switch on the lights comes on, but if everyone's driving a Tesla,
is it going to be ready for that?
No, you're right. There's a lot of money that has to go into the grid, making it available for intermittent sources of electricity like solar, like wind. We need backup storage. We need a base load that doesn't create pollution. Maybe that's nuclear, maybe that's batteries or hydrogen. The technology has to be developed. But I'm sure it will be developed. It's just what's the most efficient technology is the only issue. But it won't be developed fast enough unless we have those incentives in place.
Even with Biden's infrastructure plan?
Yeah, no. You have to start with a price on carbon.
Yeah.
If you don't get that,
right.
infrastructure won't do the trick.
Right.
And we don't have a price on carbon yet.
Bob, so final question I wanted to ask you is we're asking a lot of people about their outlook. So in 5 years' time, call it 2026, do you think we'll have a price of carbon by then? Do you feel that we'll be taking the right steps by then? How do you sort of see the world of sustainable investing by then?
Absolutely, we will have a price on carbon, and we will be on the road to net zero. Corporations will make their pledges, they'll have their targets, they'll be making progress. I'm sure we all will. There's a lot of uncertainty about what the technology will be, how these will develop, but I have no doubt that by then, in 5 years, either we're on the road to net zero at that point or it's too late.
Right, okay. But conferences like COP26, are they helpful or is it too much just lip service?
Well, so far the UN process has not delivered. Let's be honest about that. However, they are now moving to develop the mechanisms, the governance to allow for globally harmonized pricing. And so that's a key step. I think the next step that's being developed right now is the ability to create a market, a global market for carbon credits.
Yeah.
Credits that are real, that are reliable, that can be used in the compliance markets. And when that happens, that opens up the gates for investors to start investing in these technologies, investing in reducing emissions, and we're off to the races. So I'm excited about all that. There's a lot of opportunities as well as a lot of risk.
Now, if most of the world is committed to net zero within a pretty short time frame, how do you feel about China, and I know India just said they'd commit to it, but only by 2070, I think, which seems a long way out. Does that give cause for concern?
Well, the relationship between China and the U.S. is key, and right now it's a bit fraught.
Right.
But you have to understand China's way ahead of the U.S. in terms of having a federal clean electricity standard, in terms of the number of electric vehicles, the number of electric buses, the amount of solar and wind. They're just racing forward, and we're behind.
In terms of the infrastructure?
In terms of the infrastructure, in terms of pricing, in terms of many different things. It's really kind of sad. The U.S. should be providing leadership. We haven't been. Where are we? Right. That's the problem.
Well, let's hope that all changes. But Bob, it's been really great chatting with you today. Thank you so much for your time.
Sustainable investing and the role of ESG in corporate culture was something that was certainly talked about for 10 years, but it didn't really translate into investment opportunities. But now, due to the rise of indices allowing more direct investment into ESG and sustainable themes, capital allocations are accelerating these trends, creating opportunities that are only going to get bigger and more diverse in the future. If you'd like to read more on this topic, please go to FTSERussell.com/research, where you'll find much more information.